Welcome and thank you for joining me for today's educational class. My name is Joseph Budd and I'm a certified financial planner and managing partner with Budd Wealth Management. We have developed and refined our client life process over the last 20 years to work with families that aspire to a work optional lifestyle. We hope to put all the pieces of the financial puzzle together for our clients. Connect with us on Facebook and LinkedIn, where we post interesting personal finance content and invitations to future events like this on a regular basis. Also visit us at budwealth.com. This session is being recorded and you'll receive a link to the recording in a follow-up email. LPL Research presents Midyear Outlook 2025, Pragmatic Optimism. This presentation is not meant to try to predict the future. It's a way of approaching mid-year, reviewing the conditions that are present, and looking at how these conditions have previously affected the markets. A sound way to approach each period of time is by updating your financial plan, making sure that your goals, cash flow needs, whether in the present or in the future, are included in your planning. I hope you find this content of interest and the perspective shared today helpful. It was created by LPL Financial's research team. The economy. Is the economy entering uncharted waters? The current economic landscape is difficult to gauge given all the distortions that obscure the true health of the economy. After a decline in gross domestic product in the first quarter, following a surge in imports, the subsequent rebound in growth might create a perception of a strong recovery. But we think this is likely a false dawn. The whiplash in trade policy is adversely impacting official economic data and creating difficulties for investors, as it becomes almost impossible to discern whether the economy is genuinely rebounding or merely experiencing short-term fluctuations. Such distortions highlight the importance of looking beyond government statistics to industry reports from the likes of the Institute for Supply Management, or ISM, to form a clearer picture of economic conditions. The ISM Composite Index, which gives insights into business views from across the country in both goods and service industries, fell in recent months and points to a broader slowdown coupled with re-accelerating inflation. However, we continue to highlight that a resilient economy should provide a nice buffer from geopolitical shocks. Supply constraints could play a significant role in keeping inflation above the Fed's 2% target. As companies reassess and restructure their supply chains, prompted by geopolitical shifts, technological changes, or lingering disruptions from previous shocks, there will be increased costs associated with the production of goods and their distribution. This re-evaluation of supply chains could lead to shortages or delays, which in turn push consumer prices higher. Such factors underscore the complex interplay between demand-side momentum and supply-side constraints, both of which we think will ultimately work to keep inflation rates above the Fed's 2% target. That said, we forecast the Fed will cut rates in the coming months as the economy softens and the inflation rate stabilizes in the mid to high 2s. The labor market looks to be stable in the near term, but we see choppy waters on the horizon that could serve to significantly disrupt recent positive employment trends. To start, we think many companies will start to face hurdles in maintaining current employment levels, but we do see residual influences from the years immediately following the pandemic. Many industries reported having a difficult time finding qualified workers, so if the economic slowdown is fairly measured, we should expect those industries cutting hours worked before cutting payrolls. This unique dynamic could keep the labor market from experiencing the woes of a more normal cyclical slowdown. In the Fed's June Beige Book, we saw all 12 Fed districts describe lower labor demand, citing declining hours worked and overtime, hiring pauses, and staff reduction plans. Given this, it is not difficult to see lower payroll numbers in the coming months, especially if we do not get more clarity on international trade policy. Gauging this going forward, the monthly metrics on the quits rate and hires rate should give indispensable insights. The quits rate will give us a better look into workers' inclinations to voluntarily quit in search of better prospects. When the job market begins to weaken, workers become less inclined to quit their current jobs. Similarly, the hires rate measures businesses' demand for labor. Both workers and firms are experiencing a weakening labor market. The bottom line, businesses will likely become more reluctant to add headcount, but hesitant to cut headcount, at least not at the same magnitude like a normal cyclical slowdown. Ongoing trade policy uncertainty will weigh on businesses in the coming months, but as long as businesses are able to find free trade zones, exclusions, and other loopholes to defer or minimize tariff rates, we don't see trade policy as a factor in raising recession odds. American companies are currently facing significant risks stemming from tariff uncertainty, which has become a major obstacle to strategic planning and investment. Volatile trade policy, characterized by unpredictable tariff adjustments, creates an unstable environment that discourages firms from committing significant capital to expansion and new projects. When tariff policy is so fluid and unpredictable, companies are hesitant to invest in new manufacturing facilities, infrastructure, or international markets, fearing changes will erode profit margins. This unpredictable environment adds a layer of financial risk that complicates long-term planning, forcing companies to adopt more cautious and conservative approaches to growth. This hesitation not only dampens immediate growth prospects, but also prolongs the period of economic sluggishness as companies prioritize risk mitigation over innovation and expansion. In this context, tariff uncertainty remains a critical barrier to sustained economic growth and competitiveness for American businesses, and will drag on the economy in the second half of the year. Stocks' path to upside clouded with uncertainty. To help us with the difficult task of gauging where stocks might go over the next 6 months, we first turn to history as a guide. Examine how the S&P 500 fared after the last 15 corrections since 1950. The most recent correction began on February 19th and hit the 15% drawdown mark on April 4th. The first takeaway is results are all over the map, meaning the new bull market could easily break higher or lower. The second takeaway to flag is that the best stock market performance after corrections tends to come when the economy is emerging from a recession or coming out of a crisis. And while we don't know if corrections will turn into bear markets, which are 20% declines or more, and past performance does not guarantee future results, if they don't, stocks are very likely to be higher over the next 6 to 9 months. Turning again to history, the unusually sharp and swift V-shaped recovery from April 8th through mid-May has few rivals. However, the S&P 500 has rallied 15% or more in 28 trading days or less 11 other times since 1950, as it did from April 8th through mid-May. Subsequent 12-month returns for the index after these occurrences averaged 26%, with all 11 periods producing positive returns. Before you expect that much upside, consider most of these periods immediately followed recessions or significant growth scares, hardly the environment we're in today. Corrections, known as 10 to 20% declines that were fully recovered, may be a better way to assess current market conditions, given a new high for the S&P following its April to May correction could be reached in short order, as it did on June 27th. Once a correction loss is fully recovered, double-digit gains over the next 6 months are a reasonable expectation, though past performance does not guarantee future results. If stocks are going to go meaningfully higher from here in the second half of 2025, earnings will be an important part of that story. And you can't talk about the earnings outlook without the two T's, tariffs and technology. Starting with tariffs, earnings growth in the first quarter for the S&P 500 companies was a solid area of around 13%, with nearly half of that increase coming from big tech companies known as the Magnificent Seven. Normally, investors would be celebrating these numbers, but they were produced before most of the tariffs went into effect, which clouds the outlook. Perhaps the biggest positive surprise last earnings season was 30% plus earnings growth from the Magnificent Seven. Every one of them maintained their capital expenditures, CapEx, guidance for the year, or in Meta's case, increased it. This CapEx, expected to exceed $340 billion this year, is a big potential driver of earnings growth and future productivity gains. Earnings are going to need to carry most of the load if stocks are going to achieve attractive second half returns. The outlook for the economy and corporate profits remains clouded by the tariff uncertainty, a potential uptick in inflation, and the risk of higher long-term yields. In that environment, LPL Research believes the opportunity for expansion of the S&P 500 price to earnings, or PE, is limited. Recent valuations slightly below 22 times reflect a fair amount of optimism on trade policy, given below average earnings growth is likely this year and next. We forecast 6 to 7% earnings gains in 2025 and 2026 as the price increases and corporate share buybacks help offset slower economic growth and tariff-related pressure on profit margins. Trade policy uncertainty and the potential for more tariff-driven upward pressure on inflation and interest rates make the case for a higher PE tough to make. But as long as tariff rates don't go higher, we believe the S&P 500 can hold its PE near 22. LPL Research's year-end 2025 fair value target range on the S&P 500 is $6,000 to $6,100, based on $275 in S&P 500 earnings per share in 2026. Key risks to monitor besides trade policy include stagflation and heightened geopolitical risk. There are several paths to more upside. One is unanticipated productivity gains from AI investment. Another is the tax bill currently working its way through Congress that could help lift corporate profits and could suggest a general, more definitive pivot from the administration back towards a more pro-growth friendly policy ahead of the midterm elections. Lower interest rates could also help. A blue sky bull case scenario could put the index potentially at 6,450 at year end, based on a PE of 23 times and $280 in S&P 500 earnings per share for 2026. Bonds, the Jekyll and Hyde bond market, a tug-of-war between economic data and deficit spending. The Treasury curve still isn't very steep. And while the U.S. Treasury yield curve has recently steepened, it still isn't steep by historical standards. Historically, the difference between a 2-year Treasury yield and a 10-year Treasury yield is close to 1%, albeit with a lot of variability. The 2-year and 10-year spread is only at 0.48%, so we think the curve could further steepen throughout the year, with the 10-year only offering 0.5% per year more than the 2-year Treasury, but with 5 times the interest rate risk, it doesn't make a whole lot of sense in our view to extend duration within portfolios. Ultimately, Treasury yields are the average expected Fed funds rate over the life of the Treasury security plus or minus a Treasury term premium. Moreover, the 10-year Treasury yield is highly correlated, 0.9, with the expected trough of the Fed funds rate. So as rate cuts get priced in or out, Treasury yields will tend to move alongside the repricing as well. Currently, markets have priced in less than 2 full rate cuts. So as rate cuts get priced in or out, which is higher than the Fed Fund has explicitly told us should be through the trough rate. This mismatch presents an opportunity for price appreciation in Treasury securities if the Fed ultimately needs to cut rates more than currently anticipated. Should the economy, especially the labor market, slow more than expected, or if geopolitical events prompt the Fed to accelerate rate cuts beyond what is priced in, Treasury yields would likely decline more significantly from current levels. You'll receive a link to our resources page where you can access and download the full report to read at your leisure. If you don't have a process for aligning your portfolio to your financial plan, give us a call or schedule a 30-minute meeting so we can learn more about you and your concerns. I hope you enjoyed Midyear Outlook 2025. I know this is a lot of economic data that we talked about today, but again, the best way of approaching each time period is by updating your financial plan, making sure that your goals and cash flow needs are addressed in your planning. I hope you found this content of interest and the perspective shared today helpful. Thank you again for attending. I hope to see you at future events. Have a great day.